Hello everyone, welcome to Option Gig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. Today we're going to look at predefined risk trades. Wow, won't the life be great if you already know how much risk is involved in a particular trade? So that's what we're going to look at today. So let's do a quick recap of some basic concepts before we jump into predefined risk trades. 1. Naked puts and the naked calls, they have unlimited risk theoretically. We have seen if you just have a naked put or a naked call, the stock either could go down to zero or could go infinity. So there is an unlimited risk theoretically. So they also have a higher margin requirements because of the theoretical unlimited risk. Brokers would like to block a lot more capital as a margin to protect themselves. So they have a higher margin requirements. And because of these things, they are not suitable for a small sized trading accounts. If you have a $5,000 trading account or $10,000 trading accounts, you would see that doing naked calls and puts do not allow you to put lot more trades because each of the trade will block lot more capital than you would want it to. And also legally, these naked trades are not even allowed in IRA accounts, in your retirement accounts. So what's the option for small traders or for doing option trades in IRA accounts? Welcome, spreads. So spread is a combination of selling an option and buying an option. So it's not a single leg option, it's a multi-leg option trade. One option you sell and then another option you buy. But both the option legs have the same expiration period. And because you are buying an option, it reduces the max loss, but at the cost of the lower maximum profit. And don't worry, we will see example of each one of these in subsequent slides. And this is also known as vertical spread. Why it is called vertical? Because the strike prices are aligned vertically on an option chain, and hence the name is vertical spread. So you might hear names as call vertical spread or put vertical spread or call credit spread or put credit spread. Both means the same thing. Alright, so this is an example of a naked short put. Just to emphasize upon the differences so you can appreciate the value of a spreads. What you see here right now is a naked short put. It means your loss is undefined. For example, if the stock goes below your break-even point, your losses start to increase. And theoretically, the stock could go down to zero. So that means lot more losses for you. So in this example, the put was sold for $2.50 strike price. Your maximum profit is that $2.50, but your losses add up as the stock goes lower than the break-even point. So maximum loss will occur when the stock price becomes zero. I think that's pretty clear. Now we introduce what we call vertical put spread. That means it is a combination of your naked put, which was you sold a put, which was a $50 put that was sold for $2.50. But in case of a put spread, you also buy the put at $48, which is this put. So you're buying a put at $48, and hence your loss, maximum loss is now capped. So your maximum profit in this case is $1 because you sold a $50 put for $2.50. You bought back a $48 put for $1.5 or $1.50. So the maximum profit is difference between these two, which is $2.50 minus $1, which is $1. But also your maximum risk is now reduced from being unlimited to $50 minus $48 minus $1, which is $1. So in case of a spread, the maximum risk is equal to the width of the spread. When I say width, means the difference between the strike prices of what you sold and what you bought. So in this case, you sold 50, you bought 48. So the width of the spread is $2 minus the initial credit taken. So initial credit taken will be $1. So that is your maximum risk. So maximum risk on this trade is $1. Net net, to limit the loss in just a naked short put, you can combine selling a put and buying a put to create a put spread. So by creating a put spread, you can collect a net premium, but the premium is much lesser than what you have collected if it was just a naked put. But advantage is your loss is limited, and also since your loss is limited, your buying power capital or the margin requirement is also much lesser than it was for naked put spread, but at the cost of a profit potential which is now reduced. Earlier the max profit was $2.50 in case of a naked put, but in case of this put spread, your max profit is only $1. All right, now let's take an example on the call side. So this is a naked short call, means you sell a call at $50 for $2.50. So your break-even point is now $52.5. But if the stock continues to go higher than 52.5, your trades start to incur losses. And in this case, the losses could be unlimited because the stock could go to infinity. But your maximum profit is the initial credit that you have taken, which is $2.50. So now how do we limit this unlimited losses? To cap the unlimited losses, we could create into a vertical call spread, which means you sell a $50 call at $2.50, but you buy back a $52 call at $1.5. Now that means your maximum profit is $1, which is 2.5 minus 1.5, that is $1. But your maximum loss is also equal to $1, which is the width of the spread minus the initial credit taken. So now to limit a loss in a short call, you can combine selling a call and buying a call to create a call vertical spread. Now in the call vertical spread, your loss is now limited, and the maximum loss is now limited to $1, but your profit potential is also reduced. Takeaways. So the vertical spread is used to limit the maximum risk in the trade. In the examples we saw that it was limited to $1. Also it involves lesser buying power than doing a naked trade. And we'll see an example of setting up a naked trade and a vertical trade on Thinkorswim platform, and then you will see how much is the buying power difference between these two trades. So your maximum buying power will be the width of the spread. And for containing the risk, you also limit your profitability and you reduce the buying power. Most important, the vertical spreads are allowed in IRA account. So if you have money lying in IRA and you want to do option trading, this is the way to go, because naked option trades are not allowed. So now let's look at an example of how to set up these vertical spread trades on Thinkorswim platform. Okay, so now we are on a Thinkorswim platform, and right now we're looking at an apple. So one way to go is to go and look at the vertical spread vertical, and now we're looking at let's say we want to set up a 175 and 170 put spread. So I'm gonna sell this. So if you carefully look at, in this case, this is a vertical spread, put spread. I am selling, this is -1, selling a 175 put and buying back a 170 put. So the width of the spread is $5, 175 minus 70. The credit that I would receive if this trade get executed at this price is $1.90. So now let's look at how the profit and loss diagram looks like. This is how the profit and loss diagram will look like for this particular put vertical trade. So your maximum profit is $190. This is $190, and your maximum loss is $310, which is the width of the spread 500 minus the initial credit received, which is $1.90. So, and if you really look at the buying power is just $500 because that is the maximum width of this vertical spread. Okay, so this is an example of a put spread. Now let's look an example of just a naked 175 put. Let's say instead of doing this, if I were to just do a 175 put naked, I would receive a higher credit, but at what cost? So the credit received is $4.50 for this naked put, but look at my buying power. The buying power for doing this is $4,000. So a lot more money is being blocked for doing this naked short put on Apple. But if I were to do a spread, my buying power is reduced to just $500. But my maximum profit potential as well as the maximum loss both are contained. Now let's look at the call side. So if I were to do a call, sell a short call at 180, this is how it will look like in the P&L diagram. So I collect initial premium of $2.75, but my maximum loss is unlimited. Stock can go to infinity and my losses will be huge. And the buying power reduction is $3,330. Too big an amount for a small option trading account. But if I were to convert it into a spread instead of a single, let's say if I sell a spread of 180 and 185 call vertical spread, this is how the profit and loss diagram will look like. Now my maximum profit potential is the initial credit received, which is $144. This is the maximum profit potential. This is the maximum loss, which is equal to $356, which is equal to the width of the spread 500 minus the initial credit received 144, which is $356. So my maximum risk is limited to $356, but so is the maximum profit is much lesser. But look at the buying power. Buying power is only $500. So I hope this makes it very clear in terms of the advantages of using limit spread. Okay, I hope you like this. So thank you for your time. If you have any questions, you can add it in the comments or email it to me at optiongig@gmail.com. Don't forget to spread the word, subscribe to this channel. Thank you very much.